Is the world on the brink of another financial meltdown? Whispers are growing louder in the financial world, and some experts are pointing to 2025 as a potential flashpoint. We all remember the chaos of 2008, banks collapsing, economies tanking, and ordinary people paying the price. But what if I told you the seeds of the next crisis are being sown right now? And they look disturbingly familiar, yet dangerously different. Today, we're going to pull back the curtain on the global banking system, examine the cracks that are starting to appear, and ask the critical question: are we sleepwalking into a new financial crisis in 2025? Stick around, because what we uncover today could affect your savings, your job, and your future. First, let's talk about the big elephant in the room: interest rates. For over a decade, we lived in a world of near-zero interest rates. Money was cheap, borrowing was easy, and everyone, from governments to corporations to individuals, loaded up on debt. But that party has come to a screeching halt. Central banks around the world, led by the US Federal Reserve, have been aggressively hiking rates to fight inflation. This has a massive ripple effect. Suddenly, all that cheap debt becomes incredibly expensive to service. Think of it like this: your adjustable rate mortgage just shot up, but on a global scale. Banks are sitting on mountains of government bonds and other assets that they bought when interest rates were low. As rates rise, the value of these bonds plummets. We saw a preview of this last year with the collapse of Silicon Valley Bank and Signature Bank in the US and the emergency takeover of Credit Suisse in Europe. These weren't just isolated incidents. They were warning shots, revealing deep-seated vulnerabilities in the banking system caused by this rapid shift in interest rate policy. The unrealized losses on bank balance sheets are a ticking time bomb, and many are wondering which bank could be next. Now, let's zoom in on another critical area: commercial real estate. If you walk through the downtown area of any major city, you'll see it more empty offices, more for lease signs. The pandemic fundamentally changed the way we work. Remote and hybrid models are here to stay, and that means companies need less office space. This is creating a slow-motion train wreck for the commercial real estate market. Property values are falling, and vacancy rates are soaring. Why does this matter for banking? Because regional and mid-sized banks, in particular, have huge exposure to commercial real estate loans. They lent billions of dollars to developers and landlords, using these office towers and shopping malls as collateral. As these property values decline and landlords struggle to make their loan payments, banks are facing a wave of potential defaults. Unlike the 2008 crisis, which was centered on residential housing, this potential crisis is brewing in the corporate world. A collapse in commercial real estate could trigger a chain reaction, putting immense pressure on the very banks that are the lifeblood of local economies. And it's not just an American problem. This is a global storm. Let's look at China. For decades, its economy was fueled by a red-hot property market. Companies like Evergrande and Country Garden became household names, building entire cities on a mountain of debt. But that bubble has burst. The Chinese property market is in a state of prolonged crisis, with developers defaulting and millions of apartments sitting empty. This has sent shockwaves through China's banking system, which is heavily intertwined with the real estate sector. The government is trying to manage the fallout, but the sheer scale of the problem is staggering. A significant downturn in the world's second-largest economy would inevitably spill over, affecting global supply chains, commodity prices, and international banks that have lent to Chinese firms. Meanwhile, in Europe, the situation is just as precarious. The continent is grappling with the economic fallout from the war in Ukraine, an energy crisis, and stubborn inflation. European banks, many of which are still recovering from the last sovereign debt crisis, now face new headwinds. The German economy, traditionally Europe's engine, is sputtering. Italian banks are still weighed down by non-performing loans. And across the continent, the same pressures from rising interest rates and a shaky commercial real estate market are building. The emergency rescue of Credit Suisse showed just how quickly contagion can spread. The fear is that the failure of one significant European bank could trigger a domino effect, just like Lehman Brothers did in 2008. The interconnectedness of the global financial system means that a fire in one corner of the world can quickly become a global inferno. So we have rising interest rates squeezing bank balance sheets, a potential commercial real estate collapse, and major economic trouble in both China and Europe. It sounds grim, but are we destined for a repeat of 2008? Not necessarily. There are some key differences. For one, post-2008 regulations have forced major banks to hold more capital, making them, in theory, more resilient to shocks. Central banks and governments also have a well-rehearsed playbook for crisis intervention. They've shown they can act quickly with bailouts, liquidity injections, and emergency lending facilities to prevent a total systemic collapse. We saw this with their swift response to the SVB failure. The question is, are these measures enough? The regulations were designed for the last crisis, not the next one. And the political appetite for more massive bank bailouts is incredibly low. Taxpayers are weary, and populist sentiment is high. If a new crisis erupts, governments might find their hands tied, unable to deploy the same whatever it takes approach. This brings us to the most important part. What does this all mean for you? This isn't just abstract financial news. It has real-world consequences. A banking crisis can lead to a credit crunch, making it harder for small businesses to get loans and for you to get a mortgage. It can trigger a recession, leading to job losses and economic hardship. It can cause stock market volatility, impacting your retirement and investment accounts. So, what can you do? This isn't about panic. It's about preparation and awareness. First, review your own financial health. Pay down high-interest debt, like credit cards, as much as you can. Build up an emergency fund with 3 to 6 months of living expenses in a safe, easily accessible account. Diversify your investments. Don't put all your eggs in one basket. Spreading your investments across different asset classes, industries, and geographic regions can help cushion the blow from a market downturn. Most importantly, stay informed. Understanding the forces at play empowers you to make smarter financial decisions for yourself and your family. Don't let the headlines scare you. Use them to educate yourself. So, will 2025 bring a global banking collapse? No one has a crystal ball. There are serious risks on the horizon, from interest rate shocks and commercial real estate woes to economic instability in major economies like China and Europe. The complex, interconnected nature of our financial system means a problem in one area can quickly cascade into a global crisis. However, banks are better capitalized than in 2008, and policymakers are more prepared to act. The future is unwritten. It will depend on the actions of central bankers, the resilience of our financial institutions, and a healthy dose of luck. The best thing we can do is to remain vigilant, manage our own financial houses, and demand accountability and prudent management from the institutions that hold the keys to our economy. Thanks for watching this deep dive into the global banking system. I know it's a heavy topic, but it's a crucial one. If you found this video informative, please hit that like button and subscribe to the channel for more content that helps you make sense of the complex world of finance and economics. And I want to hear from you. What are your biggest concerns about the economy right now? Do you think a crisis is coming? Drop your thoughts in the comments below. Stay safe, stay informed, and I'll see you in the next video.